Welcome back, everyone. Today I want to tell you what my top 15 high-growth dividend stocks for December are. Here's a quick summary. Each month I run a stock screening process that results in a list of the top 15 high-growth dividend stock ideas for the current month. The list for November had a pretty good month, gaining 10%, and year-to-date this watch list is down 3.55%, which isn't great, but it's not terrible either. Since I started tracking this watch list in September of 2020, it is outperforming VIG, Vanguard's Dividend Appreciation ETF, by 3.96%, and SPY, the S&P 500 ETF, by 6.25% on an annualized basis. The main focus of this watchlist is to find the best combination of quality companies trading for attractive prices. I believe this is the optimal long-term strategy to building wealth. The top 15 dividend growth stocks for December offer an average dividend yield of 1.81%. Collectively, they have averaged a 5-year dividend growth rate of 29.85%, which is pretty impressive. And based on dividend yield theory, all 15 stocks look undervalued today, and I believe they are poised to offer strong long-term returns. Let me briefly explain how I pull this watchlist each month before I get to the selections for December. The watchlist is primarily made up of 8 factors that have historically outperformed the broad universe of dividend-paying stocks when analyzed collectively. These 8 factors are a market cap of at least $10 billion, a payout ratio no greater than 70%, a 5-year dividend growth rate of at least 5%, a 5-year revenue growth rate of at least 2%, a 5-year EPS growth rate also of at least 2%, an S&P earnings and dividend rating of B+ or better, a wide or narrow economic moat as reported by Morningstar, and an exemplary or standard management team also reported by Morningstar. For the month of December, these 8 factors identified 115 stocks that were all ranked based on the above-mentioned metrics with the exclusion of the market cap. The next step is to compute the current valuation for each stock using dividend yield theory. And finally, all stocks are ranked for quality and valuation and sorted by the best combination of both. The final step is to compute a forecasted rate of return for the next 5-year period for each of the stocks. This return is based on an earnings growth forecast, a return to fair value, and the dividend yield. The highest ranked 15 stocks with a forecasted return greater than or equal to 12% are chosen for the watchlist. And my long-term hypothesis for this watchlist is that it will outperform a broad quality dividend fund such as Vanguard's Dividend Appreciation ETF, ticker symbol VIG. So here's the watchlist for December 2022. This month we have SS&C Technologies, Cigna, Domino's Pizza, Ball Corporation, Lowe's, Best Buy, Monolithic Power Systems, Tractor Supply, Visa, CDW Corporation, FMC, Skyworks Solutions, MSCI, Texas Instruments, and Home Depot. There is no minimum dividend yield threshold to be on this watchlist, so some of these stocks have pretty low dividend yields. For example, Monolithic Power Systems has a dividend yield of 0.85%, and Visa has a dividend yield of 0.86%. But when you compare these dividend yields to the trailing 5-year dividend yields for these companies, Monolithic Power Systems is currently trading at 17% above its trailing dividend yield, and Visa is trading at about 27% above its trailing dividend yield. Matter of fact, all 15 chosen companies this month are trading above their trailing dividend yields, with the average potential undervaluation based on dividend yield theory being about 31%. I would like to make one disclaimer here for Cigna that appears to be about 74% undervalued based on dividend yield theory. However, given that Cigna has experienced a very fast dividend growth rate during the last couple years, dividend yield theory isn't the best valuation method for this company. I personally very much like this business, and I have left it on this watchlist because I think it's a quality company that could still offer a lot of upside in the near future. The main focus of this watchlist is on a high dividend growth rate. And as you can see, all of these companies have pretty attractive dividend growth rates, with the average 5-year dividend growth rate for all 15 companies being right around 30%. The lowest 5-year dividend growth rate this month comes from Skyworks Solutions at 14.67%. We have a few more companies in the high teens. Domino's Pizza is just shy of 20%. Best Buy is also just shy of 20%. Tractor Supply and Visa are sitting a little bit above 17%, and Home Depot is just above 19%. The rest of the companies are all above 20%, with Cigna having the best 5-year dividend growth rate of 151%. But such a fast dividend growth rate is not really sustainable, so I would expect this dividend growth rate to cool off considerably in the near future. Over in the column on the far right, I have my expected rate of return for each of these companies. The expected rate of return was computed using a discounted 5-year earnings forecast, a return to fair value, and the current dividend yield. There is also a margin of safety built into the forecasted return. These figures are just assumptions based on the available data, and there is no guarantee these returns will be attained. I mainly use the expected rate of return to make my top selections for each month, but I do expect these companies to have a better rate of return over the next 5 years than the remaining 100 stocks my initial 8 rules identified. If I compare the watches for December to the watches for November, there are 5 changes to the top 15 list. Advanced Auto Parts, Intercontinental Exchange, Lam Research, Morgan Stanley, and T. Rowe Price fall off the watch list. And replacing them, we have CDW, Home Depot, MSCI, Skyworks Solutions, and Visa. There are essentially 2 reasons why a stock is replaced on my top 15 list. 1, it either falls further down the list, or 2, it does not meet the 12% return forecast. This doesn't mean that companies that fall off the watch list are bad investments. I certainly do not sell any positions if they fall off the watch list. The main purpose of this watch list is to generate ideas for me in the upcoming month, so I don't really use it to determine any buy and sell decisions. Let's talk about past performance now. November, which had a pretty good return, supersedes October 2022 as the second best single month return since I started tracking this watch list 27 months ago. The only better month was November of 2020 with a return of 10.74%. On a year-to-date basis, the watch list remains ahead of SPY with 9.61% of alpha, but it trails VIG by 2.75%. The long-term annualized rate of return for the watch list increased from 10.61% last month to 14.97% after November. My personal target rate of return is 12%, and despite the volatility in the market this year, I remain optimistic this watch list will exceed this goal in the long run. As of right now, the watch list is exceeding my goal, with the annualized rate of return being 14.97%. After a pretty good spell in Q4, the watch list is beating VIG and SPY over the past 1 month, 3 month, 6 month, and 1 year periods. If we look at the annual returns, the partial return for 2020 was pretty weak. The watch list managed to be up 6.27% in the final 4 months of the year, while VIG achieved a better 9.09% return, and SPY was also better at 7.94%. 2021, which was the first full year for the watch list, was a pretty good year. The watch list was up 33.53%, compared to a gain of only 23.75% for VIG and 28.76% for SPY. 2022 is not so rosy, but things have gotten a lot better after the last 2 months. The watch list is down 3.55% this year, compared to a loss of 6.3% for VIG and 13.16% for SPY. Since inception, the total return for the watch list is 36.87%, compared to 26.5% for VIG and 20.69% for SPY. Let's take a quick look at the top 5 past and present watchlist stocks in November of 2022. The best return came from Nvidia, that was up 25.41%. In second place, we had Best Buy, that was up 24.69%. In third place, we had KLA Corporation, that was up 24.67%. In fourth place, we had Applied Materials, that was up 24.44%. And rounding out the top 5 is Lithia Motors, that was up 21.01%. So out of the top 5 performers in November, Best Buy was the only stock on my watch list. In total, there have been 66 unique dividend stocks selected by this watch list since September of 2020. Let's take a quick look at the top 5 stocks by total return since joining the watch list. The best stock has been ADP, that is up 98.63% over the full 27 months. In second place, we have United Health Group, that is up 68.16% over 22 months. In a very close third place, we have Tractor Supply, that is up 64.36%, also over 22 months. And in a very tight fourth place, we have Charles Schwab, that is up 63.62%, also over 22 months. And rounding out the top 5, we have Northrop Grumman, that is up 60.84% over the full 27 months. So ADP continues to remain the best watchlist stock, with a gain of 9.28% in November. United Health Group actually moved against the market last month, losing 1.33%, but it retains its second place on the watch list. Tractor Supply posted a gain of 3.41% and moved closer to UNH. Schwab posted a slightly more impressive gain of 3.89% and tightens the gap to Tractor Supply. And Northrop Grumman posted a loss of 2.54% and fell from third to fifth place, giving way to Tractor Supply and Charles Schwab. Since not all of the stocks have been on the watch list for the full 27 months, comparing a monthly average return can help normalize the results. So here are the top 5 stocks with the highest average monthly return since joining the watch list. As of right now, Best Buy is number 1 on this list, with an average gain of 5.77% over the last 5 months. Cigna is sitting in second place with an average gain of 3.82% over the past 9 months. In third place, we have Rollins, that is averaging 2.87% per month over the past 10 months. And in 4th place, we have automatic data processing that is averaging 2.57% per month over the past 27 months. And rounding out the top 5 is the United Health Group that is up 2.39% per month over the past 22 months. Let's take a quick look at the individual returns for the watches for November. So the watches outperformed VIG, with 11 watches stocks outpacing the ETF last month. The best return came from Best Buy that was up over 24%. T. Rowe Price Group and Domino's Pizza rocked returns above 17%. Lam Research came in just shy of 17%. Ball Corporation, Intercontinental Exchange, and Morgan Stanley were above 13%. Monolithic Power and Texas Instruments were above 12%. And FMC and Lowe's were above 9%. The remaining 4 stocks underperformed VIG. SS&C was only up 4.94%. Tractor Supply was only up 3.41%. And Cigna only managed a gain of 1.8%. With the final and worst stock on the watch list last month being Advanced Auto Parts that was down 20.5%. The best way to utilize the ideas presented by this watches is with a long-term buy and hold investing approach. I started tracking how such a portfolio would have worked out by tracking 2 portfolios, one that started in 2021 and the other in 2022. Each portfolio assumes you invest equally amongst the chosen 15 stocks for the given month and never liquidate these positions. The 2021 buy and hold portfolio performed well in November, returning 7.54% and outperforming SPY and VIG. The total return for this portfolio is 22.08%, compared to a gain of 15.95% for VIG and 11.81% for SPY. On an annualized basis, the portfolio has a return of 10.97%, compared to 8.03% for VIG and 6% for SPY. So while it isn't meeting my target rate of return of 12%, it is staying ahead of VIG and SPY, which is a good sign. The portfolio currently holds 54 unique positions, with the largest positions being Lowe's, Tractor Supply, Home Depot, Charles Schwab, and Domino's Pizza. The 5 best performing positions in this portfolio are Northrop Grumman that is up 71%, Progressive that is up nearly 56%, Lockheed Martin that is up 45%, United Health Group that is up 41.69%, and FactSet Data Research that is up over 41%. The 2022 buy and hold portfolio performed even better in November, returning 8.82%. The year-to-date return for the portfolio is minus 7.34%, compared to minus 6.3% for VIG, and minus 13.16% for SPY. So the portfolio is doing well against the S&P 500, but it's not outperforming VIG. However, the gap has been shrinking during the last couple months. There are a total of 38 unique positions in this portfolio due to a high turnover on the watch list because of all the market volatility. The majority of the turnover took place during the first 6 months of the year. During the last 4 months, no new stocks have been added to this portfolio. Here are the 5 largest positions: Tractor Supply, Cigna, Home Depot, Lowe's, and Domino's Pizza. And the 5 best performers are Rollins that is up 32.68%, Humana that is up 27.02%, Best Buy that is up 25.19%, Cigna that is up 24.27%, and Goldman Sachs that is up an even 20%. My expectations are for the buy and hold portfolios to produce a long-term annualized rate of return above 12%. And before I wrap up here, let me just give you some statistics on all of the watchlist stocks. Out of the 66 stocks that have appeared on this watchlist, 49 have positive total returns and 17 have negative total returns. The average return for all 66 stocks is 16.2%. which is a considerable improvement over last month when the average return was just 7.88%. The watchlist has been around for 27 months, and the average duration for all 66 stocks is just below 21 months. I've already shown you the top 5 best performing stocks since joining the watchlist, so let's look a little deeper down the list. In 6th place we have Progressive that is up 54.84%. In 7th place we have Cintas that is up nearly 48%. In 8th place we have Costco that is up 47.04%. In 9th place, we have Humana that is up 46.56%. And rounding out the top 10 is CDW that is up 46.37%. Cigna is the only other stock on this watchlist that is up over 40% since joining. There are quite a few stocks that are up more than 30%, and a handful more that are up more than 20%. The majority of the best performing stocks on the watchlist have been on the watchlist for quite a few months. And if we look at the worst losers, some of them have been on the watchlist for quite a long time, and some are rather new additions that were made earlier this year. The worst stock since joining the watchlist is Paramount Global that is down 53.71% over the past 17 months. Market Access Holdings is another poor performer that is down 49.66% over the past 22 months. In the bottom 5 we also have Ball Corporation that is down 41%, Lithia Motors that is down 38%, and Skyworks Solutions that is down 37%. That's it for today. I hope you found this content valuable. If you did, I would appreciate if you gave this video a thumbs up and subscribe to my channel to help me grow this dividend community. Thank you for watching and see you next time.